This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Record week. Stocks have their best week since the election. Will it usher in the return of the retail investor?
Shake up. The CEO of Coke steps down. Now the new CEO must figure out how to tackle a number of major challenges.
Picking stocks. Our market monitor says there are 3 companies whose shares could rise double digits over the year. He'll name them tonight. A Nightly Business Report for Friday, December 9th.
Good evening, everyone, and welcome. The rally rolls on. Not only did stocks close at all-time highs today, but the 3 major indexes advanced every single day this week, something that hasn't happened in 5 years. The gains extend a month-long rally as investors become increasingly optimistic and look for stocks that could benefit from economic growth. Here are the closing numbers for a Friday. The Dow Jones Industrial Average up 142 points to 19,756. It now sits just 1.2% from 20,000. The Nasdaq added 27 and the S&P 500 was up 13. Stocks turned in their best weekly performance since the election, with all of the indexes gaining 3% or more. Bob Pisani takes a look now at whether this wave of optimism will bring back the average investor.
The markets keep roaring to new highs, and that's impressive. But is it enough to light a fire under the average investor and get them back in the game in 2017? Now, everyone knows we lost a vast swath of the investing public after the 2008 financial crisis. And for the most part, they haven't come back, even as the stock market has come roaring back. How bad is it? It's bad. A recent Gallup poll said that 52% of Americans say they invest in stocks. That matches a record low. The high was 65%, and that was way back in 2007. And more stock ownership is concentrated in the hands of the very wealthy. In fact, about 80% of all stocks are owned by just the wealthiest 10% of households. That's it. This is the great tragedy. The S&P 500 is up over 200% since bottoming in 2009, but stock ownership has become concentrated in fewer and fewer hands. Every rally we've had in the last several years has been met with outright derision. People just aren't buying it, and many of them are now just afraid of losing money. But there's a couple of reasons that this particular rally might be a little bit different than the other ones. The most important thing is that investor enthusiasm has shot up. CNBC's All America survey, just out today, shows more folks are willing to bet on the stock market now than before the election. So there could be cause for a little bit of hope. Wouldn't it be something if the largest source of demand for stocks in 2017 weren't corporations buying back stock, but individuals trying to catch up on a decade of indifference and hostility? For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
More evidence today that investors and consumers are feeling more optimistic. The index of consumer sentiment hits its highest level since January. Respondents cited the potential positive impact of new economic policies and rising expectations that the economy and the job market will strengthen in the coming years.
And that newfound optimism was also evident in the most recent CNBC All America survey. Steve Leisman has the results.
The election of Donald Trump has brought with it a surge in optimism in the United States over the economy and stocks not seen in years. The CNBC All America Economic Survey for the fourth quarter finds that the percentage of Americans who believe the economy will get better in the next year jumped an unprecedented 17 points to 42%. That compares with results before the election. It's the highest level since President Barack Obama was first elected in 2008. The surge is powered by Republicans and independents reversing their outlooks. Republicans swung from deeply pessimistic, with just 15% saying the economy would improve in the next year, to strongly optimistic now, with 74% believing in an economic upswing.
Absolutely. Republicans are pushing that optimism up. But guess what? So are independents, and they are an important part of the country, too. For so long, we've had Democrats being kind of the lone voice of optimism, and that tends to shift when you have a change in leadership in Congress and in the Senate and in the presidency.
The poll of 800 Americans around the country has a margin of error of 3.5 percentage points. It found a majority of Americans say they are, quote, comfortable and prepared to support a Trump presidency. 56% of respondents who now back the president-elect represent a sharp change from the 43% who were asked the question just before the election.
Coming out of an election that was as angry and bitterly divided as any of us have seen in our lifetimes, it is surprising and honestly a little bit gratifying to see that a majority of Americans are willing to give this new president a shot.
The poll also finds 40% of Americans saying now is a good time to invest in stocks. That's up 10 points from before the election. Again, Democrats became somewhat more negative on stocks, while Republicans grew significantly more optimistic. The poll suggests the president-elect is onto something with his concern over jobs in the U.S. 40% of Americans say keeping jobs from moving overseas should be his top priority. It's the top choice for Republicans, independents, and Democrats. For Nightly Business Report, I'm Steve Leisman.
And to read more about the rise in optimism since the election, head to our website, nbr.com.
Nancy Tengler joins us now to talk more about the enthusiasm that's been driving Wall Street and whether or not she expects it to continue. She is Chief Investment Officer at Heartland Financial. Nancy, welcome back. Nice to have you here.
Thank you, Sue. It's good to be here.
Let's start with that basic question. I mean, this market run that we have seen has been pretty dramatic. Do you think it continues, or are you getting a little nervous with the types of gains that we're seeing?
Well, I'm optimistic that it continues. I mean, it's not a straight shot, to be sure. We'll see ups and downs, but the market's up about 4.7% since the election. I'm using the S&P 500. After Reagan's election, 2 weeks out, it was up 8.3. So, I mean, while we've had a nice move, it is not unprecedented, and the S&P multiple is not too out of line. I mean, we're at 19 times estimated earnings, and I think if we get the corporate tax cuts and the things that we expect, earnings growth for the S&P will continue as it did in the third quarter in the double-digit range. So I'm optimistic.
If I had money that I wanted to put to work, let's say I sold a house or something, and I want to put it into equities, would you suggest that I put it in very quickly to catch this rally, or should I dollar cost average in over a period of 3, 4, 5 months?
Hi, Tyler. Well, listen, I feel so much better when I dollar cost average. All of the research says you just put it in and you do much better because stocks go up more often than they don't. But I feel better when I dollar cost average, and that's what we do with our 401ks. Right. And so it is a more comfortable way to invest, and we will get pullbacks. I mean, that is the nature. Think of pruning a rose. You prune it back, it grows stronger and more beautiful. So I do think that if you just want to take your time, you will get opportunities to buy some stocks at lower levels. And we've seen really dramatic sector rotation. Right, so the pharmaceuticals are currently out of favor, right? So that's an area that looks a little attractive right now, and technology has started to come roaring back after President-elect Trump sort of jawboned some of the tech companies. So there will be opportunities. Never be in a hurry. Be disciplined.
What would you stay away from? I know you mentioned the S&P is not out of whack in terms of its PE ratio, but are there areas of the market that you think have run a little bit too quickly to the upside?
Well, yes, the financials have certainly moved very quickly, and you're looking at J.P. Morgan at $85 a share. It wasn't too long ago. It was in the high 50s. So, however, the fundamentals are behind continued appreciation in financials. We have sold our holdings in electric utilities. We sold them earlier this year because they were overvalued. We didn't move into REITs when that sector was spun, out separately. So I do think some of the super interest rate sensitive or negatively interest rate sensitive stocks like electric utilities and REITs are areas you don't really want to jump into.
On that note, Nancy, thank you. Appreciate it.
Thanks, Sue. Thanks, Tyler.
Nancy Tengler with Heartland Financial.
The head of the world's biggest beverage company is handing over the reins. The CEO of Coca-Cola says he will step down next year. Investors seem to like the move, sending shares higher by more than 2%. Sarah Eisen has more on Coke's new leadership and the challenges ahead.
A change at the top at a time of great change for America's biggest beverage company. James Quincey, a 20-year veteran of Coca-Cola, taking over as CEO May 1st. Muhtar Kent will remain chairman of the board. He told me, "It is one of my proudest days in 38 years with Coca-Cola. My biggest legacy will be the success of James, the most orderly transition in company history. Kent's accomplishments include global expansion into new markets like Myanmar back in 2012, growing 7 of Coke's brands into billion-dollar businesses, including Fuse and Smartwater, and turning around declining North American volumes and sales. But Quincy will face some major challenges ahead. Soda consumption has been declining for the last decade in this country, especially Diet Coke. Rival PepsiCo has fought the trend by building up its Frito-Lay snack business. The global economy is weak, and that includes those once hot-growing emerging markets where currency swings and consumer softness has hurt Coke sales. And finally, consumers have changed the way they shop, buying food and beverages increasingly online and on their mobile phones. Quincy says it is one of his biggest challenges ahead, digitizing the company. For all of these reasons, Coke stock has underperformed the broader market since Muhtar Kent first took the reins back in 2008, but it has still climbed about 60%. One important investor, though, is congratulating Kent for a job well done and backing this new change in leadership. Warren Buffett, whose Berkshire Hathaway owns 9% of Coke shares and is the top investor in the company, saying, quote, "I know James and like him and believe the company has made a smart investment in its future with his selection." For Nightly Business Report, I'm Sarah Eisen.
Donald Trump is expected to ask Goldman Sachs executive Gary Cohn to head the White House National Economic Council. This despite the president-elect's past criticism of the banking sector's power. John Harwood is in Washington for us tonight. Good to see you, John, as always. How influential will Mr. Cohn be when it comes to formulating actual economic policy?
Very. This is going to be a administration like most recent administrations where power is concentrated in the White House. And Gary Cohn, who is the COO, as you mentioned, of Goldman Sachs, is somebody who's going to be very close to the president, try to help him figure out how to finance some of the things he wants to do, like that big infrastructure program. And when you look at Gary Cohn at NEC, Steven Mnuchin, Goldman alum at Treasury, Steve Bannon, Goldman alum as White House strategist, the firm that was demonized by not just Bernie Sanders, but also by Donald Trump, has certainly got a big role in Donald Trump's administration.
Let's talk a little bit about Rudolph Giuliani, who is no longer in the running for Secretary of State. And as of a few minutes ago, I saw a report, John, indicating that he has taken himself out of the running for any cabinet position. Tell me about that, and who is the leading candidate for state right now?
Well, we're trying to figure that out. First of all, on Rudy Giuliani, this is somebody who was all in as a surrogate for Donald Trump, just like Chris Christie was, and it looks like both of them are going to be frustrated. Chris Christie wanted to be Attorney General. Rudy Giuliani wanted to be Secretary of State. He more or less openly campaigned for the job. Donald Trump might not have liked that. But he also faced resistance from Reince Priebus, the incoming White House chief of staff, who has been pushing Mitt Romney for this job. There were questions raised about Rudy Giuliani's past work for foreign governments in terms of his law firm and his speaking fees, things that might potentially pose conflicts, and all of that added up to him withdrawing today.
All right, as of this evening, the Senate is yet to pass a funding measure that would keep the government from shutting down. Deadline is midnight tonight, so what's going on?
Looks like that impasse is going to be broken. We've been waiting to have Joe Manchin, the senator from West Virginia, who'd been holding out for a longer duration for the health benefits for those coal miners. And Mitch McConnell, who also represents a coal state, had indicated, I'm with you in sentiment, but we've got to pass this bill with only the 4-month extension. Manchin was insisting on a dozen. But late this afternoon, Manchin came out of his office and said, my intention was never to shut down the government. Looks like the ice might be cracking and there might be able to avoid a government shutdown. All
right, John, thank you so much. Have a great weekend.
You bet.
John Harwood in Washington.
President Obama has ordered American intelligence agencies to investigate Russian hacking and efforts to influence the election. The review will encompass malicious cyber activity that dates back to 2008. The White House says it will try to make as much of the report public as possible.
Still ahead, looking for stocks to buy as the market rallies to new highs. Our market monitor has some names he says can go even higher from here. A new study shows that only about half of 30-year-olds are making more money than their parents. According to a team of researchers, that's a steep decline from the 1970s, when more than 90% of 30-year-olds earned more than their parents did. Some of the largest declines were concentrated in the Midwest, where manufacturing jobs have disappeared.
Portland, Oregon this week became the first city to impose a tax on companies based on CEO pay. It's part of an effort to tackle income inequality. The measure says that if a chief executive makes more than 100 times its median worker's wage, a 10% surtax will be added to the company's existing tax bill with the city. If a CEO makes more than 250 times, the surtax rises to 25%. The city's revenue department says more than 500 publicly traded companies could be subject to the tax. Companies like Walmart, GE, Wells Fargo. The head of Portland's Chamber of Commerce says the requirement will make it more difficult for businesses to invest in the area, and it'll have virtually no impact on addressing income inequality.
The Dallas Police and Fire Pension System voted yesterday to suspend all withdrawals and payments from its deferred retirement program. Now, that decision stopped more than $150 million in withdrawals from being distributed. Today, if those withdrawals had gone through, pension officials say the funds reserved would have fallen below the level needed to keep that fund afloat. Since August, there have been withdrawals of more than $500 million.
Biogen's experimental Alzheimer's drug shows promise, and that is where we begin tonight's market focus. The biotech company said patients experienced less brain swelling when they were given the medication in gradual increments rather than fixed doses at higher levels. The drug also reduced plaque in the brain compared with a placebo. Biogen shares fell a fraction to $287.77. The Federal Trade Commission said AT&T will shell out more than $88 million in the next couple of months to nearly 3 million customers who were hit with unauthorized charges for things like ringtones and wallpaper for their phones. It's a practice known as cramming. The refunds are part of a settlement the telecom giant reached with the FTC in 2014. Shares fell 3 cents today at $40.38. General Electric raised its quarterly dividend by a penny to 24 cents a share. This is the company's first dividend hike since 2014. Shares were up a quarter to $31.78.
Retirement services company Athene Holding raised just over $1 billion in its stock market debut. The company priced 27 million shares at $40 each, which was the midpoint of the expected range. That values the company at $7.5 billion. Athene Holding shares surged 10% to $44.05. American Airlines said it was lifting its unit revenue forecast for the current quarter thanks to a rise in average passenger fares. Unit revenue compares sales to how many seats an airline has and how far it flies them. Shares rose 3% to $49.64. And 21st Century Fox has reached a preliminary deal to buy the rest of British satellite TV provider Sky for about $14 billion. Fox currently holds a 39% stake in that company. Fox shares fell 1.5% to $28.21.
And now to our market monitor, who has stock picks he says could rise between 10 and 15% over the next year. That's pretty good. Last time he was on in July 2015, he recommended Cypress Semiconductor down about 2%, Intersil Corporation, which is up 92%, and Maxim Integrated is 24% higher. He's Don Wardell. He's portfolio manager at Ridgeworth Capital Management. Don, welcome. Let's start with Cypress, which is still on your list. One of your picks this time.
Oh, absolutely. The stock has underperformed because we went through an inventory cycle, and there was some turmoil in the management levels. We've gotten that resolved. We're burning off. We've burned off that excess inventory. Gross margins have bottomed. We've got a new CEO in place who's going to restructure the business, and we think that over the next 12 to 18 months, as they continue to have some really great products for the as the internet moves into your car. They develop a lot of the internet products for the Internet of Things for your car, and this company gets the inventory situation right. You're getting paid a 4% dividend while you wait for all this. We think ultimately they can earn $1.50 a share, put a market multiple on that, which is still cheap to the group, and you've got a stock that'll be in the low 20s and it's trading in the mid 11s right now. So we think this is a powerful one and a stock we really like.
You also like Cigna, and they are in a deal with Anthem, but you say regardless of whether or not that deal closes, you still like the stock.
Oh, absolutely. Cigna has not been buying back stock. They've been, during this negotiation process, since the deal's been announced, they haven't been buying back stock. They've been just, building up cash on their balance sheet. And, at the end of the day, whether this deal happens or not, this company is going to, if the deal happens, you're going to get a 30% pop in the stock in the next probably 2 or 3 months when we get this resolved. If the deal breaks, then you're going to, they're going to get a big windfall of cash from Anthem. They're going to start buying back stock and get back to executing their business model. I think that in 2018, we're looking at them earning probably, $12 a share, if not more. And then, you again put a 15 multiple just to be conservative. You got $180 stock on your hands, and it's 130 something today. So we think there's tremendous upside in that one as well.
So we started with chips. We moved on to healthcare. We're going to close with paint. Tell me about it.
Oh yeah. Oh man, we love paint.
Who doesn't love paint?
Sherwin-Williams. I'm sorry?
I say, who doesn't love paint, man?
Oh, exactly. Yeah, Sherwin-Williams is just a great company. I mean, all of these companies we're talking about will benefit from some of the things that are very important to investors now with, tax reform and the like. But Sherwin-Williams is in the middle of a deal right now themselves. They're trying to acquire Valspar. Sherwin-Williams owns the paint distribution with their paint stores. They do sell in some of the big box, but they're able to be price setters in their paint stores. So the market's a little concerned about the fact that the raw material for paint's going up with the price of oil, and they're able to offset that with price increases. Volumes are increasing right now.
Okay.
If you get Valspar done, integrate it's very accretive. We can see this company in the up at least 15-20% over the next 12 to 18 months. So we're very excited about paint, and it's just a really good company all the way around.
Well, Don, get out there and paint this weekend, okay? Don Wardell with Ridgeworth Capital Management. Coming up, why the rise of fake news may be sending a shiver through some very well-known brands.
And here's a look at what to watch for next week. On Wednesday, Federal Reserve policymakers are widely expected to raise short-term interest rates. Also on Wednesday, Donald Trump is scheduled to meet with CEOs from the tech sector, some of Mr. Trump's loudest critics during the campaign. On Thursday, the president-elect will detail how he plans to separate his business operations from his job as president. And that's what to watch for next week.
Safety regulators want Takata to speed up its recall of defective airbags, the largest recall, by the way, in U.S. history. The National Highway Traffic Safety Administration says the recall will ultimately affect about 42 million vehicles in just the U.S. New models are also being added to the recall list, including the Tesla Model S, the Ferrari, the Jaguar, Land Rover, and McLaren. Well, there is big money in fake news, and some of the most recognizable brands may be inadvertently funding the sites with false or misleading stories. Julia Boorstin explains.
Fake news stories are the latest evolution of clickbait. Juicy but entirely made-up stories designed to generate clicks. Some users can't tell the difference, and neither can some of the algorithms that place ads. Now the Wall Street Journal and others are raising questions about the fact that fake news stories are sometimes paired with ads for big brands, such as this made-up article in an ad for a Ram truck made by Fiat Chrysler, thereby inadvertently funding fake news sites. Fiat saying at this time there is currently no truth-filtered technology, and until the technology gets more sophisticated, we must work individually on a site-by-site basis to exclude the growing list of URLs and domains considered harmful. Secretary Hillary Clinton just yesterday raised concerns about potential real consequences of fake articles after a man fired shots inside a Washington restaurant that was falsely accused of harboring a child sex ring linked to the former candidate. Clearly, brands wouldn't want to be associated with those kinds of stories.
It's now clear that so-called fake news can have real-world consequences. This isn't about politics or partisanship. Lives are at risk. It's a danger that must be addressed, and addressed quickly.
So how do these ads end up next to fake news? In part, it's due to retargeting technology. An ad can follow a consumer to a fake news website after he or she has visited a brand's page. And there are a number of middlemen. Companies like AdRoll help advertisers place ads online, finding space on websites through several partners. And AdRoll is partnered with Google, the leading digital ad company, which said it would stop placing ads on sites with deceptive or misrepresentative content. But Google's crackdown hasn't entirely been working. Google saying, quote, "We're in the process of implementing the new policy, and these early stages have demanded increased human review." And Facebook Chief Operating Officer Sheryl Sandberg also weighed in on the controversy surrounding fake news and the steps the company is taking.
There have been claims that it swayed the election, and we don't think it swayed the election, but we take that responsibility really seriously. And we're looking at things like working with third parties, helping to label false news, doing the things we can do to make it clearer what's a hoax on Facebook.
And in the meantime, brands like Fiat's Ram are taking steps to make sure they are marketed in what they call brand-safe environments. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching.
And I'm Tyler Matheson. Thanks from me as well. Have a great weekend, everybody, and we will see you on Monday.